Hey everybody, welcome to the Index. I'm your host, Alex Kehaya, and this week I'm excited to be joined by Jacob Phillips, co-founder of Lombard, a financial platform specializing in liquid Bitcoin staking. This is something that I haven't really heard much about yet, but I'm excited to hear more. Lombard enables users to stake their Bitcoin, earn rewards, and maintain full liquidity. Thanks for being on the show.
Awesome. Thanks for having me.
So before we get too deep into what Lombard is, I'd like to just hear from you kind of your story and why you're in the space. Like what gets you out of bed in the morning to build this company and product and a little bit about your background.
Yeah, good question. I think the way I kind of tell it is I was always a debater growing up. I was arguing with my dad. I was arguing with friends. I was arguing about something, trying to find greater truth. And, I could have gone a number of different routes. My original plan was to go into politics, work at a think tank or something like that. However, turns out the way you change the world is actually going into the private sector rather than public. So a lot of the think tanks I saw were doing good research, but they were just sort of arguing back and forth. At the end of the day, it's like, and I think we're starting to see this right now in politics, right? Like the guys with the biggest voice are actually the biggest, the guys who built the best companies and that kind of thing. So I originally was like thinking, okay, how do I have the most influence in whatever it is? Like if I want to enact change, how do I, acquire enough influence to enact that change? So my original plan was then to go work in finance or something. That was the next place where I thought like, okay, these guys have a ton of influence. This must be it. So when I became like I went down the finance track, did some investment banking, was trying to become a researcher at hedge fund. So again, was kind of debating the stock market, but even then it felt like something was kind of missing there. Then I had like locked down a sort of penultimate internship, had a ton of time on my hands, started reading about all these tech entrepreneurs, totally foreign space to me. Just went all in on it and was kind of hooked from there. Started a CS degree, ended up getting a gig at a small little startup accelerator in Cleveland of all places. No interesting tech companies coming through there really, but they sort of forced me to sit down and look at things. They were starting a crypto fund at the time. I kind of got staffed on that. I wasn't too happy at the time, but sure enough, after diving into it, it's like, crypto is going to change the world in so many fundamental ways. It's like trust as this programmable primitive is just, again, transforms everything that I think we see and know of today. And it's one of those things where I actually think Coinbase does a really good job of these commercials where they sort of show like in very like easy to understand terms for everyone, how the system is just incredibly broken. It's all these things where like, 50 years from now, we'll look back and we'll be like, why did we ever do it that way? That was crazy. So, I think I just kind of got hooked from there, and then it became too good for me to pass up on. It was something that I was ready to go all in on. Work is one of those things where it's like, if you're going to be doing it, you might as well love it. If I was in finance right now, I'd probably be like working for someone's boss's boss, and the opportunity to start fresh in crypto, build something net new for the world, ended up I think pretty good for me.
Do you know by chance the Hawkins School? Random side note.
I know of Hawkins. I used to debate them a little bit, and then obviously I went to school with some guys. I went to school at Case Western in Cleveland, so there were a ton of people from Hawkins.
Yeah, Doris Korda, who I think she was like the assistant head of school there, but she ran what was called the Hawkins Institute, which was like a entrepreneurial studies program that she built out of there. But yeah, that's my connection to that area.
Oh, nice. Okay. We might be thinking of different Hawkins then. Funny enough, there's a Hawkins in Cleveland.
It was like a high school. It is a high school. I think.
Oh, it is a high school. Okay.
It's a high school.
Perfect.
Yeah, it's a high school. Yeah.
Nice.
Okay, so but Lombard, like what led you to that, and what's the why for that business?
Yeah. So the story of Lombard is I spent 3 years at Polychain, beginning of 2020 to end of 2022. While I was there, what'd you say?
I said that's cool.
Yeah, thanks.
Yep.
Yeah, Polychain was a lot of fun. A lot of great folks there. While I was there, I basically spent most of my time focusing on DeFi, kind of out of interest. Everybody, all the sort of researchers on the venture team get to specialize in whatever they want. But I joined beginning of 2020. A couple months later, Aave, Uniswap started gathering volume. Compound launches their token. Uniswap launches token DYDX, and it's like DeFi summers in full force. So I spent most of my time focused on that. Invested in a Bitcoin DeFi company while we were there, never really came to fruition, but always knew I was going to do something DeFi. Then left and joined DeFi Purpose Protocol, was kind of building like very deep kind of in a subsector of DeFi focused on just a small piece of the pie. And, while that was great, it sort of, I think it had me a little bit too narrowly focused. I went from researching everything that was cool happening in the space then to like just this really small section of it. And Bitcoin DeFi has kind of given me a chance to pop out of that. So the real story is there is, I had some friends at Polychain who were looking at Bitcoin DeFi in a big way, kind of trying to understand where the opportunity might be. We started jamming on this, ended up flying out to Singapore, did this kind of like offsite where we were just kind of figuring out where the opportunity was. I got, really excited about Babylon. I'd been familiar with the protocol, but hadn't dove into it as much as I had hoped to. And it just was very clearly the turning point for me. So Bitcoin DeFi has been like this obvious opportunity that everybody's thought would someday come to fruition. The question was, what would be the catalyst to make it happen? And I think Babylon was kind of that. So look, I think the combination of an opportunity that was too good to pass up on, a chance to build with friends, and really a chance to step back and have a little bit more of an impact, I think, on the DeFi space. Like I said before, I think Lombard's solving a real need in a sense that everybody's looking for net new liquidity, and onboarding net new liquidity in the form of Bitcoin to on-chain finance is something that I think that, Lombard as a team is pretty well set up to do. And I think it's pretty well suited to my strengths. It's been cool to like kind of take a step back, still focusing on DeFi, but instead of competing with a lot of the coolest projects building in the space, now I'm sort of going to some of the biggest Bitcoin holders in the world and, sort of pitching the good news of all the best DeFi protocols in the space. So it's cool to become a little bit more of an advocate for everything cool that's happening rather than just being sort of narrowly focused on one specific craft.
So yeah, talk to me about that a little bit. Like, first of all, just backing up a little bit higher level for people who don't maybe like new to Bitcoin or don't really understand like what DeFi is. Like, why is this important, for Bitcoin? I think I know what it is, but like for people who don't, maybe just in your own words, educate them a little bit.
Yeah, definitely. Well, look, most of what's happening most of what's happening in crypto in general, I think is DeFi at the end of the day. Even Bitcoin. Bitcoin was programmable money. Then we had programmable financial software, and now we have like I guess programmable ecosystems, right? We're like moving up the stack as we go. We started at the base layer, then we built like borrow lend protocols and kind of your basic DeFi on top of that. Now you're getting like AI agents on chain. You're getting all kinds of like DePIN. Like I think this is sort of where it heads, and it's like at the end of the day, all of finance is built on this primitive of trust. In this case, trust is like some big institution that you hope will trust or will hope will not screw you over. It's like legal agreements, it's governments. The question is, how can we replace each one of those with something better? Bitcoin DeFi is actually a great exemplification of this too. Obviously, I think in crypto sometimes we get a little bit too narrowly focused on or rather we hear things and sort of don't embody them. Bitcoin DeFi is a great example of this. Nobody wants to trust each other here. My Bitcoin is the most people view their Bitcoin as the most precious asset in their portfolio. They don't want to give control to a custodian. They don't want to give control to a trusted third party, and they certainly don't want to give it to a couple of random guys building a Bitcoin liquid staking token. So it's like being able to build these truly non-custodial protocols, I think is next level in every sense of the term. It's one of those things where, like I was saying before, we're going to think back to banks where we just sort of blindly sent our money there and trusted that it was going to be ready for withdrawal when we came back for it. And we're going to compare this to Uniswap and Aave and fully non-custodial protocols and like the financial ecosystem that we're building through all of this wallet infrastructure and DeFi infra. And it's going to be silly that we ever gave over full control to somebody else now that we have this primitive.
The one product that you didn't mention that I think everybody needs to pay attention to, and I'm just going to say because I've been becoming so bullish on it, is Squads. Squads protocol.
Squads is cool.
And they have a Squads protocol is like the B2B version. It's the one that you use for like a business. And then Fuse is like just for individuals, Fuse wallet. And they built both. And the crazy thing is that they're finally realizing this dream that I've had, which is like, I don't ever need a bank account. Like I can go to Squads, I can set up a multi-sig, I can fund it with my business partners, and we can run our entire business from there. We can issue credit cards. We can take USD and it automatically gets changed into USDC. I can wire off-ramp USD as payments to people if I need to. But like I can keep all my treasury in Squads and never off-ramp. And up until now, I always keep it like either in a multi-sig or on a hardware wallet. And then I move just what I need for payroll into my bank account.
Well, this is pretty cool.
Like, I can literally do business from freaking Squads. Like they just announced that they're going to start issuing credit card debit cards. that you can use, just like Mercury Wallet. So I'll be able to do like a virtual and physical debit card with on-chain programmatic spending limits.
Yeah,
that I can
that is
share
really
with
cool.
people. That's like, for me, bringing all of the economy on chain, especially things like e-commerce, but just business in general. That is what's required. For like for everything that's outside of like what you would think of as traditional DeFi, right? You want to onboard 1 million small businesses. This is the way you do it, is with this. The other thing about Fuse, and this is not implemented on Squads, I don't think yet, is that Squads is more like crypto native. Like you have wallet signing and you set up a multi-sig, and that's kind of like you're sort of in the space if you're doing that. Fuse though is like more like, I don't know if they use MPC technology or something, but like they have this recovery process that doesn't require seed phrases, and like setting up the app and going through KYC was like 5 minutes. I mean, it was it's way easier than setting up a bank account, and you get like all the same benefits, and self custody. So I just like, I think we're really seeing a turning point here. And I think what you're building is a part of that too, right? Like, actual use cases other than store of value for Bitcoin. And I think this is one of the things I was trying to get out earlier when I asked you the question, is like, people don't like, Bitcoin is money. It's this a store of value, but like people, whatever narrative you want to say for it, but you can't do much else with it. You can send it to people, and you can hold it, and that's about it. And you can sell it, buy it. That's about it. So what you guys are enabling is to like, you stake it on your platform, and then I get something back, lBTC, that I can use in other places to generate yield. Can you, like, first of all, I guess backing up, like, I've never heard of Babylon, so I'm like not really in the Bitcoin space, honestly. Like I've known about Bitcoin for a really long time, but I've been working on Solana primarily since 2021. And so I know virtually nothing about what's going on in the Bitcoin space. Talk about being like hyper focused. I've been like Sol all the way.
Right.
So what's Babylon, and like, give me a broad overview of just like what's going on there.
Yeah, definitely. Well, before I get into that, let me just touch base on the, kind of discussion around Squads and Fuse. I'm familiar with Squads. I haven't used Fuse, but I'll have to check both of those out. I think you hit on a really, really good point, which is anybody who uses stable coins or like gets involved in DeFi immediately understands why this is 10x better, or like they immediately understand why it's significantly better than using a bank, sitting there paying wire fees, banks closed on Sundays, this kind of thing. But we haven't had the infrastructure for people to actually use it yet. And certainly what's kind of cool is like at the, when I was at Polychain or at some of these big institutions, they all have the infrastructure right now. I mean, most of those guys could do USDC for all of their payments if they wanted to. Everything's set up, like Anchorage accounts are freaking awesome. Fireblocks is super cool. When I was just about to leave Polychain, there was this big push of like a ton of Fireblocks competitors popping up. It kind of sounds like what you're describing with Fuse, where it's like, pretty sophisticated MPC tech. It has all of the sort of institutional features you'd expect. Like you can set withdrawal limits, all of this stuff. Argent tried to build this back in the day, never quite got it with a full smart contract wallet. But as soon as that kind of infrastructure is widely available with like a UX that's halfway familiar to people, I think I'm totally with you. I don't think anybody will go back to using a bank account right now.
These guys have crushed it, I'm telling you. Like I just used the wallet, and they just released Fuse not that long ago, and I signed up. Yeah. It's one of the best user experiences I've had, period.
That's
End
cool.
of story. Like outside of crypto, like it's easier than Venmo, right? And it's a full on virtual crypto bank account. It's an actual bank account. They have wiring instructions I could send you right now, and you could send me $1,000 and I'll get USDC in my account. I don't have to do anything. Yeah. Like I'm raving about this because I run 2 businesses on chain, and it is a effort for me to do that. And this will make it effortless for the first time, I think.
That's awesome.
So I'm like mega bullish on it. But you got me excited about that when you're bringing up like, all these different utilities you can get with DeFi, and now anybody can really participate in it. Before it was really just crypto people like you and me who could play around, and like Bitcoin holders, like they're going to know what you're talking about. Right. But I think honestly, I've become convinced that Squads is like one of the industry defining companies. Like they're going to create a sea change like that. The product has the potential to my hair is like standing up. Like they have the potential to like really make it so that there's like 1 million businesses who do business in USDC. and get yield, right? Like you can't even tell them about yield when they can't issue a debit card or like accept a wire or pay their employees like in USD, right? Like easily.
Yeah.
But that problem's getting solved now. And they integrate with Bridge. So I think Bridge, there's just a bunch of technologies that, like, you were talking about these competitors that popped up. Like we've seen this happen. I'm an angel investor too. Like I've been an investor and I've seen a bunch of different deals that have like repeated themselves. And just because like it didn't work out once doesn't mean that it won't be successful in the future. It's really a lot of times in our industry, it had to do with how hard it was to go to market. Like a lot of these teams have had to raise a massive amount of capital because, like, my last company, Olaplex, we were like this NFT platform, and we died for a lot of reasons, like right after FTX collapsed or shortly after that. But we had to invent technologies that didn't exist on Solana in order to operate. And now there's these composable parts that exist that allow you to get usage of this stuff. And I think what you guys are doing is in that vein, because before there was no way to get, like, what else are you going to do with Bitcoin? Nothing. Right. And that I do know enough about like the Bitcoin space to know that that's a problem. But I want to talk about that with you. I want to understand better, like Babylon, how lBTC works. If I'm a Bitcoin holder, like, how do I use this thing? What kinds of things can I do? That kind of stuff.
Yeah. So let me try and tie all this in. So you're sort of right on this. Before Lombard and before Bitcoin DeFi, there wasn't a whole lot you could do with your Bitcoin. However, there were still some things you could do. Everything that you could build on top of Bitcoin, you had to build in the form of a centralized institution. So you built FTX, you built BlockFi. I know that Coinbase, exactly. Or like there's Yellow Card, which is like Bitcoin payments for all of Africa. But again, it's like you're trusting some guys who are running a centralized server who may or may not get hacked at some point, right? It's just this like centralized honeypot. So part of this was like, in the absence, once FTX and BlockFi finally let you down and you're back to, okay, now there's literally nothing to do with my Bitcoin. This is when there finally was enough of a incentive for people to start exploring non-custodial DeFi for Bitcoin, right? And in this case, it's sort of the same thing. It's like, to start, we can't build directly on Bitcoin. There's not smart contracts. So if I want to build something with greater expressivity, I have to like build this second layer. And actually, Babylon was one of the first to sort of break that congruence right there, where Babylon found a way within Bitcoin script to be able to. So Babylon started off as this time stamping protocol. All it was basically saying like, hey, you can update directly on Bitcoin to say like some block is final, and that's it. It didn't really have much use. What the real turn of events was when they realized that they could couple the timestamping mechanism that says like, hey, these, I'm timestamping this block from another chain onto Bitcoin main chain. I couple that with a Bitcoin that is staked in that time lock, plus a spending condition that basically says, if I sign 2 blocks at this block height, then this key gets revealed and anybody can go steal my Bitcoin. So it's basically like they found this little hack to create a slashing mechanism, which then if you can sign block updates from another chain with some sort of slashability, you basically recreated eigenlayer, but on Bitcoin L1. So that was the magic there. And this combined, if you look at what happened in the eigenlayer ecosystem, I think this is a good parallel for what's kind of happening in the Bitcoin space.
So you wrap the Bitcoin, you stake the Bitcoin in this timestamp thing, which you're basically
in a time
lock, but you're still like, how does it allow someone to take it? It reveals the private key to them.
Exactly. So there's this.
Where's the private key going? That sounds sketchy, dude. That sounds sketchy.
It does a little. So this is the thing. This is like a really. There's a lot of Bitcoin infrastructure that's built on this mechanism. It's called an extractable one-time signature, or don't quote me on this. It might be a one-time extractable signature. I'll have to get the terminology right. But basically, it's a mechanism exactly for this. So think of it as like the time lock itself has a public-private key pair. So my Bitcoin, my like address has a public-private key pair. This time lock that I put around this has a public-private key pair. And it basically says, if I do this thing, which is the spending condition, then the private key gets revealed and then anybody can, this vault is now open to the world, right? And so the only way this vault gets open to the world is if I do something that is deemed against the spending condition. In this case, it is, I say 2 blocks are final in the same update, right? So it's like, it's a brilliant mechanism, I think, in a lot of ways.
Okay, so the way it works, though, is that another chain could sign that transaction, or
not
could
another
send a
chain.
Message.
No, it would have to come from. It's basically you signing from your private key, to block updates at the same height. So the only one who can mess this up is you. Like the validator who's actually signing updates to this is the one who has all the control here. In the same way, if you're delegating to Figment or P2P to stake your whatever token, they are the ones who are actually signing updates. So they're saying like, okay, I have reviewed this block is final, I will now sign for that. If they sign 2 blocks on 2 different forks, that's equivocation. That then, anybody can submit a proof that slashes that asset. So this is kind of the same thing.
Where is the slashing coming from? Give me an example of something that I would do to get slashed for.
An example of you doing something would be signing on 2 different forks. So this is like classic double signing. So this would be like, at block height 1000, I sign fork A and fork B, and I pretend that they're both final. They can't be both final.
But this assumes I'm running my own node, right?
You're running your own node, exactly. Yes. So this would be like
I'm staking to someone's node. I'm essentially staking to someone's node. Like I could stake on your node, and if your node F's up, then I lose my money or whatever.
Or you can stake on your own node, though. That's the thing. Babylon allows you to, in a fully non-custodial way, stake directly from my own wallet with no other trust assumptions, including the Babylon team. Like this is one of the coolest non-custodial mechanisms I think that's been created. I can also delegate to your node. I can delegate to Figment or P2P or one of the big node operators. So certainly there'll be a lot of delegation.
Why would a validator like what's the other, is there some other, like Eigenlayer, when you use the Eigenlayer thing, I think, okay, I'm a validator. I'm doing providing a service somewhere for something with my node.
Yep.
And that's other than just writing Bitcoin transactions, right? Like, I'm doing something else. What are some examples of that they're doing?
So it's almost the same thing. In Eigenlayer, you have AVSs coming to Eigenlayer looking for security, and then you have LPs who are delegating that security to those chains. Exact same thing happening in Babylon. So the validators will choose which chains to validate based on what BSNs, Babylon Secured Networks, are offering rewards. So I will direct my Bitcoin, my slashable Bitcoin, to whatever chain is offering me the best rewards. And then I will sign block updates, or myself or the validator for that matter, will sign block updates to earn those rewards effectively.
And who's on these other chains, are they using different kinds of validator software? Like what is that chain made up of?
So they're using the exact same validator software that any other node would be running. So a good example of this would be like, there's a lot of projects in the Cosmos ecosystem looking to use this. So this would be like, I am Osmosis and I want to utilize Babylon security.
Yeah, so but they're a Cosmos chain running Cosmos, and all their validators are doing that, and they're getting economic security from, they're doing their thing. And if a Cosmos validator is getting some delegation, economic security from the BSN as part of the BSN, then and they do poorly, they perform poorly, they provide bad data or whatever, that would trigger this slashing thing.
Exactly. But
so how does the validator on Bitcoin know that happened? That's kind of the thing that I'm trying to get to, is like, how does the validator that's working with because it's 2 servers. We're talking about 2 servers here. We're talking about a Bitcoin node and a Cosmos node, and they have to talk to each other.
So they talk to each other through the finality provider effectively. So think of this as the validator. So there's sort of 2 different slashing mechanisms here. There is a slashing mechanism native in Osmosis. I actually don't know if Osmosis has slashing turned on, but let's assume they do. There's a slashing mechanism internal to the chain, and there is this Babylon slashing mechanism. And you could also add in an Eigenlayer slashing mechanism. None of the 3 know about each other. That's the basic thing. So you can have economic security native to the chain and a side bet on top, which is Eigenlayer or Babylon or some other security market that also provides economic security to the chain, but indirectly. The 2 don't have to know about each other. I think that's the big piece here. So what's happening here is you just have a finality provider in Babylon they're sort of doing 2 things. They are running an Osmosis node, or they're running some node for a BSN and validating that chain effectively. And then they are also pushing those updates. They're doing something very specific, which is signing basically a block at which is final to the Bitcoin main chain. They might not be signing every block. They're, signing every so many updates or something like that. But that's sort of how that works. So it's like Babylon could have a slashing event without impacting the BSN consensus.
Yeah, but what I'm not understanding yet is how does my BSN node, my osmosis node, tell, or how does my Bitcoin node know that the osmosis node messed up? How does it know?
How would
I'm not grokking something here. Like the osmosis node isn't valid, isn't signing transactions on Bitcoin, and it's doing stuff over here. And there's a consequence if it provides bad, if it does something bad. Let's say it sends me bad data to the chain, something like that, right? Or tries to do a double spend on osmosis. So there's a consequence for that, which is slashing. And if the BSN, it's participating in this BSN architecture, then you lose Bitcoin. How does the BSN know that node didn't do the right thing?
So in this case, I don't know precisely how this works, but there's cryptographic proof. That I think is the gist here. If two block updates are signed at the same height, you know that there's equivocation, right? This is like a very simple case. I think what you're kind of asking is like, how do I know that you're signing a block that is actually final? And somewhere in the actual construction of the finality provider makes it such. Basically, like Babylon finality providers are IBC compatible, so you could actually see through. I believe this is how it works. Actually, is like Osmosis would sign a block that's final. The finality provider would sign an update to Bitcoin or Babylon chain that would say that block is final, and then through IBC, anybody could submit a proof that says actually Osmosis finalized a different block, not the block that you said was final, and then you could get that slash would occur.
I'll have to research that. Yeah, that's like,
it is a really cool mechanism.
I get the idea. I'm just like, it's that piece is like really critical, and the reason I keep asking about it is because Bitcoin is not programmable, right?
Exactly.
Like, I get the timestamp thing. They're like allowing you to get some kind of if then, yes no binary kind of thing to happen. And if it's a no, then it gives away the private key, which is where the money then gets slashed, but it really gets sent to the person you hurt, right? Like whatever is kind of the idea, right? The economic value gets sent to the person who you need to pay out for failing to provide a service.
Exactly.
Okay, but all right, let's zoom out a little bit. I can do some research on that, but like with lBTC, how do I get lBTC? Like, how does because are you guys a BSN? Do you have is it a BSN?
We will become a BSN, but right now you can just think of this as a protocol that allows users to stake Bitcoin and have a liquid representation of this. So users give us Bitcoin, we stake it into Babylon, and then mint lBTC, which is a liquid representation of that staked Bitcoin. This gets minted on ETH mainnet. Within a couple of weeks, we'll upgrade to Lombard Ledger, which will allow you to mint across just about any chain.
So I mean, in a way, it's another mechanism that does something similar to Zeus, right? Like Zeus, are you aware of Zeus on Solana? So
I think I know Zeus. Yeah, think of Zeus is a bridge from Bitcoin to Solana. Think of Lombard as that. Like Lombard will also mint lBTC on Solana.
Yeah, because I think they mint zBTC, and what they're doing is a little bit different. They have sort of an MPC architecture where you like send your Bitcoin into this MPC wallet, and there's guardians who secure it. And if you want to get your Bitcoin back, you can just send it to, send your zBTC back, and it will automatically send the original BTC back to your wallet on Bitcoin, on the Bitcoin network. So a little bit
functionally,
different.
I think that sounds a lot like Lombard. So Lombard has this Lombard consortium, which is because you can't build anything directly in Bitcoin smart contract, Bitcoin script, you have to build something on top. The only way to practically secure as much, Lombard has $1.6 billion of TVL right now. We have our eyes on $10 or $20 billion total. The only way you could actually secure that right now is through some sort of, large consortium of like independent but well-known parties who are basically staking their reputation to secure the system.
It occurs to me that like a better way to describe this, because I get why it's called non-custodial, but MPC with a guardian type network around it is really like semi non-custodial, right? Like, because you do still have to trust the parties involved, and you are giving up the asset and putting it in there and getting a representation of that asset back. So you don't really have that asset on Solana. You have a representation of that asset, which is stored in essentially a bank that is a multi-party bank. It is a little bit different.
While I agree with that, I think by that definition, then nothing is truly non-custodial. Even Uniswap, Uniswap has an upgrade function owned by the Uniswap DAO. And then you could even say even a permissionless smart contract with no upgrade ability is sort of secured by the validators of the ETH network or the Solana network or something. But you're totally right. There's a spectrum to all of this. Yeah,
right. You get into kind of minutia around decentralization and trust assumptions, which I'm not a maxi when it comes to that kind of stuff. I do think the only thing that is truly self-custody is a wallet with seed phrases that you control on a sufficiently secure network, right? Like Bitcoin is probably, you could say Bitcoin, Ethereum, I'd argue Solana too, are sufficiently secure to say you're actually self-custodying. And I think that comes down to can it be censored? Can it just be shut down easily? Can you just lose your funds because of something like that? Whereas a Guardian network with 20 operators on it, that's pretty. It's like having a huge multi-sig with a lot of signers, and so you're relatively sure nothing's bad's going to happen to you, but there's still some trust assumptions that have to be made.
Totally.
But okay, so I got my go ahead. Yeah,
I was just going to say, we talked about this sort of NPC design where you have some group of independent parties who are validating transactions. This is probably best case scenario for Bitcoin DeFi. Most Bitcoin DeFi actually isn't that. It's more I have a centralized custody account. The team is sort of comprising the multi-sig. This is you sort of see the full spectrum of this because we don't have a nice
bridges,
shared
security.
Right?
Bridging stuff to mainnet Solana in most cases is just a centralized thing, right? I mean, in most bridges, period, right?
What bridges are you thinking about there? I think there's definitely.
Which ones? What do you mean? On which chain?
I guess I meant there is. Everybody looks at WBTC or USDC in DeFi, and they're we can do better than that. We can build real DeFi mechanisms. But in Bitcoin DeFi, what I'm basically saying is when people go and rebuild those mechanisms, they kind of just build them the same. They use a centralized custodian. It's the team who's only involved in that transaction. The actual minting of on-chain, of something cross-chain is sometimes done manually. It's not even fully automated. At least something like an Axelar or a Wormhole or Layer Zero, while there might be a consortium of oracles effectively, there is still some it is still an automated process with some transparent trust assumptions there.
Yes. Yeah. I would agree with that.
Yeah.
So I have my lBTC.
Yep.
What are some things that I can do with it now? What are different protocols that I can participate in and generate some yield off of it?
Yeah. So this was something we spent a lot of time thinking about when we were launching this, because what lBTC is meant to be is this security first blue chip DeFi primitive. And a DeFi primitive can be used in anything. Our goal is anywhere someone would want to use their Bitcoin, they can now use this staked representation of that Bitcoin. In the same way that STETH at this point has sort of become ubiquitous within the ecosystem with ETH. People kind of view them as interchangeable. And in fact, while EigenLayer was blowing up, almost nobody wanted to deploy ETH into new protocols because they could deploy STETH or EETH or some staking or restaking token that was earning a ton of EigenLayer rewards, plus also being able to do this thing in DeFi. So I think where we started with was we need deep liquidity. So Lombard went to most of this ended up minted natively on ETH mainnet. So we went to the Uniswaps, the Curves. Then we went to lending protocols. So Gearbox and Morpho were both launch partners. Now you can use it on Zero Lend. We're about to get added to Aave, just passed a temp check, are just sort of waiting for final approval there. Moonwell's another one on Base we've been working with. So think of it as any big blue chip DeFi protocol you want to use this on, you will be able to eventually. And maybe the one thing that I'm really excited about that hasn't quite happened yet, but I think is coming, and I think this will take us to the next level, is lBTC as a primitive on centralized exchanges as well. Think of this as my sort of thesis is that yield-bearing tokens are going to be something DeFi native that transforms the whole financial ecosystem, not just the most DeFi native of DeFi protocols. Everybody's going to be building upon these, and this already happens in TradFi. It's just a matter of a new form of tokenization that's brought this to DeFi.
One thing I love about these models, and maybe this is how you guys, I'm kind of making a leap here, but if I stake my BTC on Lombard and I get lBTC out, am I also providing security? Like I'm also guaranteeing.
If I stake lBTC on Lombard,
if I stake BTC and it mints lBTC, am I participating in the security of the Lombard network?
So you're not directly, but we will have a mechanism to do this. So you'll be able to, you'll sort of be able to restake your lBTC and then participate in the security.
And then you'll get like lLBTC back out.
Kind of, yeah.
This is where like this DeFi stuff starts to get really funny. Is he's like, you keep stacking on additional acronyms or whatever. But I mean, that's cool. That's cool. Cause then now you can park it there, earn yield on it. And this is how like liquid staking works on Solana, right? Like you get, you actually can end up getting more SOL back because you're just accumulating and it's restaking back to the pool. It's not restaking like a BSN or a no consensus network on stake pools. But I like,
is it covering slashing risk or what?
We don't have slashing on Solana yet. We don't have slashing. Oh, well, so, on Solana, there's stake pools, which are just a means for automating decentralization of stake. And, and they're managed by like stake pool providers. It's a program that's on chain. It's open source, fully audited. You can deploy one and then you're like the pool manager and you can take a small fee and your job is just to like figure out a way to attract stake. And then you just keep adding more and more nodes and distributing the stake across those nodes based off of whatever criteria you want to set. Like you can set like IP address, like location, performance, set like commission rate, right? Like, so only stick to nodes with certain commission rates. And then it gives you a liquid staking token back. So the initial use case for pools were people who wanted a liquid staking token so they could stake, earn the yield, and then go do the thing I was just talking about with the joke around lLBTC is like, do that, basically that same thing. And so you would participate in the security of Solana, but you also got to still go have fun and play around in DeFi. But you have to maintain your like Marinate is one, right? I think they have MSOL. And so you have to hold on to your MSOL, right? To go back, if you want to get your SOL back out, you've got to return the MSOL and get your SOL back out. And then there is restaking coming to Solana through, Jitto and Solaire. Those are the two teams that are building that. I'm actually talking to Jitto about doing a no consensus network, that's what they call the BSNs or no consensus networks.
Nice.
And the thing I like about what Jitto's done is they have built their protocol for restaking to be super flexible so that any NCN that comes along can kind of design the different carrot and stick models and how those work. They haven't taken like a very opinionated approach. They've just kind of provided a framework that a developer could come in and then now implement on their own. And I did a podcast with Brian from over there a little while back. I don't think it's come out yet, but he talks about it on the show.
That's cool. I will say one of the limitations of Babylon is that they can only do a very specific type of security for networks right now. However, like you said, Eigenlayer, it sounds like Jitto can all do sort of fully programmable forms of security markets. And Lombard has actually been thinking about this a decent amount. You got me kind of excited when you were talking about restaking your lBTC, because this is exactly the type of AVS we're designing right now. So eventually you'll be able to do this exact thing. Think of it as like almost like an insurance mechanism or a sort of dual tranche system that will allow some people to stake into Lombard and get like a lower rate of return, but with almost no financial risk, as where people who are more comfortable with the technical risks can actually boost their yield without doing a whole hell of a lot much extra. And I think this is actually where a lot of, there is question around how much product market fit, or like rather not PMF, more like the scalability of these security markets. Like, how big can Eigenlayer get? How much revenue can they get through the system from people paying for security? And I actually think the evolution of security markets from just double signing into all of these different use cases, insurance, tranching, things we haven't even thought of yet. It's almost like we're just thinking of restaking now as putting collateral to work in any additional way beyond just beyond just security. So I think there's cool stuff that's going to come from this market. I mean, it's only been around for like I don't know,
not long,
9 or 12 months, right?
Well, I think one thing that occurs to me when you're saying that is I think there's fundamentally very different. I don't think this is intentional, but I think the approaches in the market development is just fundamentally different between Ethereum restaking and Solana restaking. And I helped start one of the largest online communities for alt SVM chains, which we kind of now rebranded themselves as network extensions. And in some cases they are actual extensions of mainnet, but in a lot of cases they really are just like a roll up or their own L1 in some cases with like a bridge. And with, again, like people tend to nitpick around terminology. I don't really care that much. But I personally don't think that space is going to be like what happened on Ethereum, where you've got 1,000 L2s, because Solana mainnet is just dominating, right? Like it's performing really well. They just like last month, 55% of all crypto users were on Solana. Not that they weren't in other places, but they were on Solana. And node consensus networks on Solana I think they really are more about, like, there might be some L2s and stuff like that try to use that to get economic security. But really, I think the more, what we're going to see more is like actual extensions of the network, where there's a network of, like, one of the things we're working on in my company, ABK Labs, is building an on-chain economy for the read layer of Solana. And to do that, we want to enable validators to actually offer RPC services to the ecosystem and earn revenue from that. And we're looking at implementing an NCN for that. And so that's like an example where I would say, like, this is directly related to mainnet, providing a service that validators can provide on mainnet for mainnet users and developers. And I think there's just more stuff like that. Like another one is like called Magic Block, and they call themselves like an ephemeral rollup, where, like, for gaming use cases, if there's a lot of congestion or it's a really contested state, they spin up this like thing on the side that routes all the state for that gameplay, whatever's happening through that node. And then it gets settled all at once on mainnet, back to mainnet, and still has that security. But the throughput remains high for gameplay because it's just going through one server, like one centralized server at that point. And so it's just a routing mechanism. And that, I also think, could be like an NCN network with a lot of people who are participating and offering that service kind of on demand, because you need latency, right? Like low latency, specific locations. And so I think that is fundamentally different than like an app chain, right? Or something like that, where it's totally disconnected, or where like the economic activity is moving from ETH L1 to L2. And like you look at Base, right? Like who's capturing all that value, right? Yeah. Coinbase is capturing most of the value there. And it's going through like a centralized sequencer. Great business model, still programmable money, not really decentralized. Users don't care that much about decentralization, unfortunately. So, unless you can deliver like that user experience in a truly decentralized fashion. But I don't know. I forget where I was kind of going there. I kind of lost my train of thought, but like, I do think it's fundamentally a little bit different. And when I think about what you're doing with lBTC and wanting to generate yield, like I could see the kind of economic security you're going to provide to people on Solana, like NCNs on Solana, is really going to help secure services that relate more directly to mainnet than other chains. Just
well, definitely. And I think one of the points you've been making throughout this podcast is there's so much cool stuff happening on Solana. We don't need to rebuild all of this infrastructure just to get some new asset. In this case, like most of Lombard's thesis is that we can bring Bitcoin liquidity to any chain on the planet. Like let these chains have their own specific use cases. Let ETH do what ETH does best. Let Solana does what it does best. I don't know. All these other chains can kind of specialize for different purposes and use cases. And then liquidity can just be this thing that flows into wherever the best stuff is being built. In this case, I think you've been selling a pretty good point that the combo of squads and Jito and the DeFi ecosystem on Solana, combined with this sort of really cool. I'm not familiar with that other project you were talking about, the ephemeral rollup, but it's a really cool rebalancing mechanism.
Yeah, and they're open source. They just open source that whole thing. I can send you their GitHub repo if you want. It's just kind of cool to look at. And I know the team over there, they're really smart. One thing I'm really excited about for this, like you guys, there's a couple of projects like trying to bring Bitcoin liquidity to other chains, and specifically Solana. Man, I want to run the nodes. Like they'll mint, they print Bitcoin. Like you can run a server that just prints Bitcoin, that isn't like validating mainnet necessarily, like the Bitcoin network. You know, I don't know if it's going to cost more or what, but like it just seems like a cool opportunity. Like running a Zeus node, running a node for you guys. In our company, we like one of the core things that we've built is like open source software for automating running infrastructure, specifically on Solana. But we're like also looking at like other areas where we can like lower the OpEx, operational expertise needed for that. Because I think like it's just another great way for people to earn Bitcoin, you know?
Yeah,
like
definitely.
That's awesome.
Well, hey, we should chat then. Lombard is on the verge of launching a Cosmos SDK chain called Lombard Ledger, Common BFT, very sort of standard BFT consensus. We'll be expanding the validator set significantly. And, you know, if I'm thinking a year or two out, I wouldn't be surprised if Lombard eventually gets to the point where we can sort of forego this permissioned consortium approach and go to a fully permissionless validator set. And
that's
all
the path
of this
most people are
day,
taking. They have to control it in the beginning. You can't just like open it up. There's too many issues.
Exactly.
So.
Well, and I was going to say, this is sort of maybe the exciting part. Think of the consortium also for Lombard. Like you described this as like a semi-custodial approach. Think of this as a temporary solution. Bitcoin eventually will have some ability to spin up truly, you know, trustless L2s, either through BitVM or Opcat. It's like almost a certainty. Give it another 2 years and this will be a reality. I think when that happens, Lombard will be able to leverage that technology. In the meantime, this is kind of the best we can do. So hopefully one day there'll be a truly trustless bridge from Bitcoin to Solana that allows you to mint stake Bitcoin there, use it within the ecosystem. And I guess we'll ride off into the sunset then.
Yeah, I'm there for it. So we're at the top of the show, but what have I not asked you that I should have asked?
That's a good question. I don't know. I mean, I gave a little bit of insight into where Lombard's headed, but you know, the story of Lombard has kind of been we're the biggest stake on the Babylon network. We're sort of one of the only usable forms of Bitcoin and DeFi. We're usable soon after a couple integrations. I think we'll be usable in just about all the DeFi protocols you can think of, including all the blue chips. We are, for a long time, we were the second biggest pool, WBTC pool on ETH mainnet, and we're the second largest CBBTC pool on Base. We would be the largest if it weren't for virtuals, which has you know, in the price appreciation has actually taken us over. So long story short, it's like the reason you should care about liquid staking primitives at all is because Bitcoin. Nobody's ever really cared about Bitcoin and DeFi. The question is, why are people going to start now? And I think that like the catalyst of Babylon and the ability to, you know, encapsulate yield and a cross-chain Bitcoin into one primitive in the form of lBTC is the catalyst that makes this happen. DeFi protocols are you know, love Lombard because we bring new liquidity to the protocol. Same with chains. This is sort of what you're going to see. And I think you know, I think Bitcoin maybe on Solana is a little bit nascent. I know there's a lot of WBTC there. I'm excited to bring lBTC there quite soon. We'll be doing some cool stuff with Drift and Gauntlet and hopefully the Jupiter folks as well. But it's kind of only a matter of time. There's no reason ETH should have like taken, you know, sort of won the show in this context, or same with Sol. There's no reason these native assets. Bitcoin is the best collateral. When people first built all these, you know, when people built like BitMEX and all these centralized exchanges, I mean, Bitcoin is the collateral on all of those centralized institutions. It's about time it comes to DeFi.
Well, and once you unlock the floodgates, the flows can happen just crazy fast. This is like if you haven't been in this market, you might not realize it, but if I've seen DeFi stuff just go lightning, capital flows across markets, cross chains, in permissionless fashion, like at the speed of light. So you know, you can. There's always this tipping point, right, where all of a sudden, just like there's this explosion of DeFi activity when there's like a new primitive invented, and you guys might be that catalyst, but. Well, we'll have
every cycle. Go ahead. Yeah, just on that last point, I was going to say every cycle, I feel like we get a new, you know, we notch the bar higher on just what like capital moving at the speed of light looks like. At first, it was like $1 billion going into something, and then it became 10 billion, and I don't even know what. I mean,
like Hyperliquid. They just launched and they're doing 10 billion a day. Like crazy, it's crazy, dude. Yeah. Yeah, I mean, it'll be really cool to see what happens. I think, you know, one of my hypotheses for this bull market that I feel like we've just entered is that Bitcoin on Solana might be the big thing, that because no one's really talking about it. There's so much happening that's great on Solana, and everybody's got their eye on meme coins. But man, I think Bitcoin on Solana might be a big thing. very soon. So,
well,
we got to
looking forward to being in that ecosystem for sure.
Yeah. Thanks for coming on the show, and definitely we'll help you out once you guys are ready to come to Solana. I can help make a lot of introductions. So
sounds like a plan. Well, hey, thanks a ton for having me, Alex. And we'll have to get you involved in the Lombard consortium.